Today we're analyzing what the Federal Reserve will do on May 3rd. And what they're going to do, it's either going to pump the stock market and the cryptocurrency market, or it's going to crash the stock market and the cryptocurrency market. It's also going to affect the bond market, the housing market, and the overall economy. So the Federal Reserve, they're in control, and we need to anticipate what they're going to do to us. So here's what we want to know on what's going to happen on May 3rd. We want to know, will they raise interest rates or will they pause? We want to know, when will they start cutting interest rates? And we want to know, when are they going to start printing money again? So let's solve this puzzle with all the clues at our disposal. We're going to have to put our detective hats on. So keep those three questions in the back of your mind, because right now I need to tell you what they said at their last meeting that ended on March 22nd. The Fed minutes were made public yesterday on Wednesday. And this is going to give us clues for what they're going to do on May 3rd. So in the Fed minutes, it shows that several members wanted to raise interest rates at their last meeting by 0.5%. However, because the regional banks were collapsing, they chose to raise interest rates by 0.25%. So the question is, would they really have done a half-point hike if it were not for the banking crisis? And it appears that the answer is yes. There's a good chance that they would have raised by 0.5%. Instead, they chickened out, because of the banking crisis, and they went with 0.25%. The minutes say, and I quote, "Participants would have considered a 50 basis point increase in the absence of the recent developments in the banking sector. Participants agreed that recent banking developments would factor into the committee's monetary policy decisions." So there you have it. This confirms what I told you. And I said it multiple times, that the Federal Reserve is paying attention to the banking situation, and it is affecting their decision-making process. So they said it explicitly in their minutes that were released on Wednesday. I also said that credit flow will affect their decisions. And that's been confirmed on Wednesday as well. The minutes say that they need to monitor data to anticipate a credit crunch, and that they need to stay flexible on their decision-making process. So the four biggest variables for the Federal Reserve are the March CPI report, the jobs report, the health of the banks, and credit flow. So I hope that makes sense, and I hope that we're all on the same page. Now let's talk about the March CPI report. So if you want the details of the actual reports, please refer to my video yesterday. Headline CPI fell from 6.0% in February to 5.0% in March. So that sounds great, it looks great, but when you look under the hood, it wasn't so great. As a matter of fact, the stock market went down on the news. So some people are saying that headline inflation went down massively. Therefore, the Federal Reserve will not raise interest rates on May 3rd, that the Fed will pause. Okay, so that's one side of the argument. The counter argument is that core inflation says otherwise. Core inflation rose by 0.4% month over month. Core inflation went up year over year to 5.6%. That actually accelerated from February's 5.5%. Therefore, rising core inflation will keep pressure on the Fed to raise interest rates one more time. All right, so those are both camps of the argument. You have headline and you have core. So the question is, does the Fed prefer to use headline or core as a better gauge of inflation? And the answer is that the Fed prefers to use core. So that's not good. Core inflation is remaining stubbornly high. It's actually going up. And that's not a good situation with oil prices on the rise again, because that means a headline CPI could just snap right back up in any given month. Now, moving on to the jobs report. So the jobs report for the month of March was still relatively strong, 236,000 jobs added. The labor market is still tight, and that was a clue on how services inflation would show up in the CPI report. And it came in just as expected. It came in high, up 7.1% year over year. It barely budged from 7.3% in February. So that's way above 5.6% core, 5.0% headline, and 2% target. And the unemployment rate, it fell from 3.6% in February to 3.5% in March. The Fed says that unemployment will move up to 4.5% by December. So from the perspective of this component, this is a green light for the Fed to put more pressure on the labor markets. Now we have to take a look at the health of the banks. So this is coming from the Fed minutes, and they're saying that the banking turmoil will be limited to, and I quote, a small number of banks with poor risk management practices. So the Fed also said, and I quote, the banking system remains sound and resilient. So that does not indicate an interest rate pause. So that sounds like they believe that they can raise interest rates another 25 basis points and the banks can handle it, except the banks with poor risk management practices. Shame on those banks. Now, when it comes to credit flow, yes, the data indicates that it is slowing down, but it's not frozen, at least not yet. Additionally, the Federal Reserve is seeing tighter credit flow as a tool to help them fight inflation. They're taking an optimistic view of the situation. The glass is half full. So this is the theory. After one more rate increase, the Federal Reserve can stop raising interest rates because tighter credit flow will suppress the economy and bring down inflation. In other words, you crush inflation by crushing the American consumer. So they're basically thinking that they won't have to raise rates any further because tighter credit will get the job done. It'll do the trick for them. Okay, so the most recent data shows that banks are lending less because of the turmoil, and that is expected. They are becoming defensive. The major surveys show that small businesses had a more difficult time receiving a loan in March compared to last year. And this data is showed up in the New York Federal Reserve survey, which we covered yesterday. So take a look at the other surveys. They're going to say the same thing. The Fed said that bank lending contracted by the most on record in the last 2 weeks of March. But again, this should be no surprise. The question is, how much further will banks tighten credit availability? That is unknown. So after reviewing those four components, I believe that the odds, the market expectations, I believe that they are justified. The odds are chances of a raise, 66%. Chances that they pause, 34%. So that answers the first question. Those are the probabilities, and that's why they're at 66 and 34. So it's because that there are more arguments in favor or green lighting another 25 basis point increase. If they raise interest rates, the stock market, the cryptocurrency market, they're both not going to like that because there's still a considerable amount of people expecting a pause, 34%. So let's review the second question. When will the Fed start cutting interest rates? When is the Fed pivot going to be? Jay Powell and the Fed, they're saying that it's not going to happen. It will not happen in 2023. On May 3rd, Jay Powell, he's going to say that again. He's going to stick to that story. However, the markets are calling his bluff. They do not believe Jay Powell. Market expectations are the June meeting, a pause is expected. The July meeting, a 50% chance of a Fed pivot. If not by July, then an 80% chance of a Fed pivot by the September meeting. But I want you to remember, I want to say this. Most people know this, but I'm just trying to pass this information along to the stragglers. A Fed pivot does not mean that we're going to instantly jump into a bull market. History shows that there's more downside in the markets after the pivot. Well, soon after the pivot. That is because of the lag effect. And the last question is, when is the Federal Reserve going to start printing tons of money again and create more bubbles for us? So right now, the Federal Reserve is doing the opposite of money printing. They're doing quantitative tightening. It's called QT, abbreviated QT. But it's not that simple right now because of the banking crisis. In reality, right now, the Federal Reserve is printing money, but it's a temporary thing. It's called stealth QE or backdoor QE. So it's not money printing, but it's not money printing. It's something else. It's something new. So if we turn a blind eye towards that, whatever that is, the question still stands. When are they going to start the money printing QE process again? So for this one, they're going to say the same thing. On May 3rd, they're going to say the same thing. They're going to say that it's not going to happen in 2023. And they will definitely stick to that story, their QT story on May 3rd. The Federal Reserve will start cutting interest rates before they start their QE process. So that's just how it works. There's a progression to this. So here's the order. The order is that they slow down the pace of rate increases, which has already happened. Then they're going to pause, and we're waiting to see when that pause will happen. After that, after the pause, then they're going to start cutting interest rates. And then after that, they start printing money again. And then we get more inflation, we get more bubbles. And that's when you and I, we make a lot of money in the markets. And that's when we sell at the top. So in a nutshell, that's how all of this works. And I want to end with this. The Federal Reserve said in their minutes that they're expecting a recession later this year. They're expecting it to be mild and short. They expect a recovery in 2024 to 2025. They think that the recession is going to start with the banks and it's going to spill over into the broader economy. So to me, okay, when they say that, I do not believe that that is far-fetched. The banks, well, they're going to have to become more defensive. Lending will slow down, that is expected, and consequently, the economy will further slow down. And then boom, we're in a recession. But it's not like the banks caused this. It was the tightening of financial conditions that will cause the tightening of credit. And the Fed, they had to tighten so rapidly because of bad monetary policy. They thought that inflation would be transitory, and they were late to act properly. So if you think about it, I mean, they were raising interest rates by 75 basis points, 0.75% at each one of their meetings. That is crazy. So let's see what happens on May 3rd. The only thing to disrupt these current expectations are a freeze in credit flow, further banking turmoil, or a black swan event. So let's see what can go wrong in the next 20 days. So I'll be here to alert you if something does happen. If you're an investor, please check out our website for exclusive stock market content. There's a link down below. If you're not an investor, please disregard and don't waste your time. I'm sure you have better things to do. Thank you for all the support. Please subscribe. I wish you a very nice day. Take care.